Hello, and welcome to today's program, Preparing for a Restaurant Financing or Sale Transaction, Key Considerations for 2025. Disclaimer, this program is being recorded and is intended for informational purposes only. Nothing should be taken as legal advice, and any information, question, or discussion should not relate to any client matter that may be considered privileged or confidential. If you have a question for our presenters today, please type it in the webinar Q&A box. Kicking off our presentation today is Riley Laugesen, a shareholder out of our Portland office. Riley, you're welcome to begin.
Oh, hi, everybody. This is Riley Laugesen. I chair the restaurant industry practice here at GT. Great to see everybody today. Thanks for taking the time. We have got a great session and a lot to cover in the next 45 minutes. We have over a dozen of our specialists on our restaurant finance team and subject matter experts here to talk about what I think is a topic near and dear to the hearts of many on this call. Restaurant finance and preparing for a financing or sale transaction. This is supposed to be and hopefully a very interactive session. And so we're going to try to get through the content in about 30 minutes and reserve the last 15 for Q&A. But if you have questions in the interim, please feel free to submit those along the way. Restaurant finance and going to market, whether you're a buyer or seller, it's a lot like preparing your house to go on the market. If you're the brand or if you're an investor, it's a lot like purchasing a house. Before doing before putting a home on the market, there's obviously a lot of important things and considerations that one might want to do in order to get the best outcome. And it's no different when engaging in a financing or sale transaction, because if your business is not in good shape and show ready, the prospects of a successful outcome are not as good, obviously, as if they are. 2025, in terms of restaurant deals, more of a continuation of 2024, 2023, 2022. We thought this was going to be the year we finally had some semblance of normality and market certainty, but that has not happened. I can't remember the last time the market was quote unquote normal. It was maybe around 2014 or 2015, but we've been through a real ride in the restaurant space for the last decade or so, and that continues. Obviously, there's still inflation concerns, there's tariffs, there's a new administration, there's all types of things going on around the world. But that said, there's a lot of transactions in the works and a lot of transactions getting done right now. Especially, we've seen more interest in the last year or so in a renewed interest in emerging brands, and also an emphasis on franchisors and franchise brands in the marketplace, among others. So there's certainly a lot of capital on the sidelines and a lot of interest, and there are a lot of deals happening and getting done. So let's jump right into this. Kelsey, I will turn it over to you.
Thanks, Riley. Before we dive into the different substantive areas of getting ready for a transaction, I'm going to briefly talk about the importance of getting fit for a transaction. Like most things in life, preparation, training in advance, those are the things that are key to success when it really matters. And this is definitely true for restaurant transactions. The more prepared you are, the more likelihood of actually getting to that closing and on the terms that you're hoping to achieve. One of the main reasons for this is speed and efficiency. In a sale or financing transaction, usually a faster pace benefits the seller. And here we're talking about the seller being a restaurant operator, raising funds, or selling the business. The longer a deal drags on, the more issues that can emerge. Also, leverage can change. A lot of times at the LOI stage, as a seller, you may have quite a bit of leverage, but after that, it can switch. Also, just outside of your deal itself, there's always external factors that can come up that you just can't predict, whether that be a global pandemic, tariffs, or other factors that can change the appetite of buyers to transact. So if you put in the time up front, this really speeds things up. It allows you as a seller to identify material issues that might come up during a transaction. And once you identify them, ideally you could resolve or mitigate them in advance of going into the transaction, thereby saving quite a bit of time. And even if you can't, hopefully you can develop a strategy, talking points, so that when you're in the transaction, you're prepared and ready to go with what might come up. So what are we talking about when we say getting in shape for a transaction? Well, first of all, early on, you're going to want to assemble your advisory team that helps you get in shape. Think your coaches, things like that. The team usually consists of an investment bank, accounting firm, a law firm, and ideally your advisory team will be experienced in restaurant specific transactions that'll allow you to get advice on the best way to structure your transaction, if you have the right structure in place to begin with, a strategy for going out to talk to potential investors, buyers, and kind of just what they're seeing in the market and what would be recommended in your specific case. Another key piece when we're talking about pre-transaction fitness is we're talking about being proactive with due diligence. And due diligence is one of those topics that it's a huge part of every deal. It's time consuming, it's frustrating. A lot of people don't really like doing it, but it's a very key piece. It's where things come up. And it's not a mystery. So a lot of this is the work that you can put it in ahead of time so that when you're in the transaction, you're not bogged down by putting a lot of your team working on diligence and not being able to focus on running the business or other issues that come up that you weren't able to anticipate. So, assembling that information, putting your lists together, and a lot of that is what we're going to talk about today. And we're really talking about legal diligence, not the financial or your accounting. So I think with that, the first one we're going to talk about is the key to structure. I think Riley will be talking us through that.
Thank you, Kelsey. Yeah, the question everybody has to ask before engaging in a transaction process is the structure of your company fit to transact? And in restaurants, that is not often the case. We find companies that come into a transaction that do not have the entity classification or the structure or the coordination between the business that many investors are going to like, especially if it's a professional investor, a private equity group, or what have you, or a strategic looking for a growth investment. And so understanding if your structure is the type that is going to facilitate a transaction is very important. And we'll go through a number of very common scenarios quickly, and you can refer to more of this in depth in our article that accompanied the webinar materials. But common scenarios that suggest a restructuring may be necessary if there's multiple entities with varying ownership and there needs to be a roll-up or some form of buyout or repurchase in connection or before the transaction. If there are S-corps, a common scenario, if there's any S-corps, identifying that right up front and talking to your advisory team about how to deal with that, because that can present issues. If a business needs critical assets transferred into it or excluded from it, if you're looking at doing a transaction and not a certain brand may be carved out of the transaction, or for a multi-concept operator, or IP or other valuable assets need to be transferred in, important to understand that. Businesses that have operated what we call a cash flow model, that have been flowing out distributions or dividends to equity holders as opposed to growth, it's a model that's very different than a growth model. So if you have a business that is either one or the other, and needing to understand what your investor is looking for, you may want to consider some restructuring or realignment before going into the transaction. Also, it's very common with many earlier stage restaurant groups or multi-concept operators, there will be a management company in the business that takes fees for services, usually gross revenues off the top or so forth. A number of investors are not going to be amenable to that structure and going to want to move towards a more conventional comp model with executives and others placed on wages or salaries moving forward. So 5 common scenarios, more about that in the article in depth if you would like to read about that. But now I will turn it over to Landis to talk about corporate diligence.
Thank you, Randy. So once you've established what you that your corporate structure is as you want it to be, and it's ready for the transaction, as Riley alluded to, you want to, as part of the due diligence process, the investor or acquirer will want to see the actual documentation that establishes that what you're describing as a structure is in fact legally the case. For example, they'll want to see, the actual filed copies of certificate of formation, all of the most recent up-to-date filings. Make sure that every applicable entity is still in good standing in every applicable jurisdiction. If you've expanded and opened stores in additional jurisdictions, they'll want to make sure that you properly are qualified in those additional states. And they'll want to make sure that these governing documents, such as the operating agreement or stockholders agreement, depending on your form, are actually signed by all of the parties and are up to date. And the investor is going, so in connection with any transaction, there's going to be a change of at least some of the ownership. And so they're going to want to establish that the ownership that is before they invest is what they think it is. When you send them a spreadsheet saying this is our cap table, they're going to want to confirm that is in fact the case. For that purpose, they'll need actual complete and signed documents for every stock issuance, every transfer, and the like, such that they'd be able to recreate the cap table from scratch. Earlier Riley analogized that it's kind of like selling a house. And if you imagine if you were to list your house for sale, and then the inspector says, well, you got some cracks in your foundation. Well, the fundamental documents of a corporation or an LLC are kind of like that foundation. So you want to identify any problems and solve them ahead of time. And most of those problems can be solved, and it's just it's a lot cleaner if you fix it before you start the process at all. Kellen?
Yeah, thanks, Landis. And we can flip to the next slide too. And I'll touch on a couple other corporate points. Like Landis said, the cap table is really a really important one to confirm that it's up to date and complete. So if you have equity or non-equity grants, if you're granted stock options, as an example, do you have copies that were actually signed by each grantee and just going back out and tying out that process? Or when the first company was first starting out, maybe there was a promise of equity, but you're missing signatures. And really, before you do a deal, or even if you don't, you want to make sure that all that is papered and properly documented correctly, such that, if you're listing someone on the cap table as 10%, you actually have something to support that. Because like Landis mentioned, not having that could just lead to a whole host, of different problems. Second point to touch on is just to make sure that the correct entity actually holds the business assets it's supposed to. We see that a lot of times, like when a founder, maybe they start the company and they file for a trademark when the company's first starting, when that trademark should really be owned and held by the company itself. Or sometimes domain names is a common example where they're registered in an individual's name that was working for the company. But again, those should really be held in the company's name instead. So just important to have that finalized before you run any type of process. And then the last point I'll touch on, and Riley, I think, touched on this too, on the tax piece and S corps, is just to confirm your current entity and your tax structure aren't going to have unintended tax consequences. So obviously situation dependent, but just important to pay attention, especially if one of your entities is taxed as an S corp. There's certain rules that involve structures with S corps, like limits on shareholders, what types of shareholders you can have, etc. A lot more detail than that, but just wanted to flag at a really high level. So on that note, I'll hand it back to Riley for some IP considerations.
Thank you, Kellen. For any brand, any restaurant brand, intellectual property, some of the most valuable assets. For franchisors, for example, without having federal trademark registrations on principal marks, it can create significant problems with the expansion of the business, and also company-owned businesses as well. There's 4 types of IP. Trademarks, trade secrets, patents, and copyrights. With restaurants, trademarks are typically the most important, not to discount the other 3, but trademarks are almost always critical intellectual property in the portfolio of a restaurant company. And so it's important to make sure that those marks are clear for use and protected, ideally federal trademark registration, and not just as principal trademarks and logos, meaning the name of the brand or any key logos that are being used, but also think about logos, taglines, menu names, or other valuable IP that will be of value to an investor or buyer. Also, really important to make sure that the business owns all the IP. With independent contractors, the rule is that if there's not work for hire language in any agreement, the contractor will be the owner of the IP. And this is an area where brands get caught up sometimes because they enter into arrangements with architects or designers or others as independent contractors, and you get into a transaction and there's no documentation that shows that the brand owns the intellectual property, and then the investor is wanting that documentation. You have to go out to these other parties to confirm IP ownership, and it become an undesired negotiation. So the article contains quite a bit more information on intellectual property protection and what's important, but those are some of the highlights. And another important area, I'm going to turn it over to Allison to talk about real estate.
Right. In addition to intellectual property, sophisticated restaurant investors and purchasers understand that real estate, in addition, is often in the form of leasehold interests as opposed to ownership interests, maybe some of the restaurant's biggest assets or their biggest liabilities, unfortunately. So one of the things that we typically do is we'll analyze those locations, or we'll help with the previously existing analysis, and we can help in terms of terminations or other options with respect to those specific locations. Some of the things to do on the front end are creating abstracts so that you have a baseline and an understanding for some of those key issues and topics within the leases, and an understanding, to the extent you don't already, of the commencement date, the expiration date, so that we can think through the logistics and the timeline for when and if something may become an issue, or if there's room for negotiation. Part of this is also assessing each specific lease for the notice and consent requirements in connection with financings and sale transactions. One of the key issues is understanding whether the landlord actually has leverage in that situation and can try to extract something more. It can be sometimes very contentious, but hopefully not. That's another item that if you are able to do on the front end and negotiate into those leases, better permitted transfer provisions and exclusions with respect to change of control, that's helpful. And then in connection with successful locations with short remaining terms, some of those are actually about negotiating extensions and giving yourself greater flexibility, more time, in addition to if you have an unprofitable location to try and increase the value of the business, it may make sense to negotiate a lease termination. And I think I can turn it over to Jason.
Thank you very much, Allison. So now we're going to talk about labor and employment issues. As you may be aware, savvy investors and purchasers typically will view both executive and store-level personnel as some of the most important assets of any restaurant business. While some investors or buyers will want to make new hires in connection with a transaction, some also may want to work with the current executive talent in some form and for some period of time, which may depend on the role, the type of the investor, and the importance of those individuals to the business's ongoing needs. Now we'll talk about some tips in the labor employment space, and I'll turn it first to Ellen.
Morning, good afternoon, everyone. So, you know, as sort of we've heard throughout from many of the speakers so far, you know, being prepared for a transaction is important, and in the L&E space, that includes conducting privileged audits with the assistance of counsel to ensure compliance with not only federal laws, but state, and as probably many on this call know, the many varied local laws that exist specifically for hospitality and restaurant clients, given that the requirements can vary greatly from jurisdiction to jurisdiction. In that regard, given that compliance with all applicable employment laws, regardless of the extent of a business's knowledge of those, is generally a standard representation in any transaction. It's really critical to identify, evaluate, and promptly remedy potential non-compliance, not only for transactional purposes, but obviously, you know, given I sit in Los Angeles, so California is ripe for litigation in the employment space. Therefore, being ready for a transaction and minimizing legal risk with respect to employment issues is obviously going to help you in other aspects as well. You know, given that the opportunity to transact can arise at any time, sort of having a practice, a standard practice of conducting audits on a routine basis, whether that be annually or otherwise, is always a great practice. And related to that, part of keeping a tight ship relates to keeping your documents compliant, up to date, and drafted in a way that will protect the business, inform employees, and well position you in the eventuality of due diligence and having to share those documents with the other side. And with that, I will turn it over to Ryan, my colleague who deals with the more contentious adversarial side of employment compliance issues.
Right. Yeah. Thank you, Ellen. Yeah. Look, as if you're operating a restaurant, you're going to have employees, and with employees come problems, and sometimes that includes litigation. And as Ellen mentioned, that's one of the things that that I spend most of my day doing. As part of a transaction, you're certainly going to want to have your employment litigation team as a part of one of that sort of advisory committee that we mentioned at the outset of this call. And part of that's going to mean evaluating any active, pending, or threatened employment litigation. And if there's litigation that's either active or on the horizon, it's just helpful to work with employment counsel as you're approaching a transaction to make sure you understand the actual cost of that and then timing of any resolution, because those are going to be really important aspects of getting this transaction over the line. That is important really for any kind of litigation, but it is particularly important for litigation that will not be covered by insurance. And as many of you I'm sure know, a lot of that's going to be your sort of wage and hour exposure. I know particularly in California, I also sit in Southern California. We look at California-based PAGA claims, the Private Attorney General's Act under the Labor Code, and also at uninsured wage and hour class actions. Those can be really large liabilities. And of course, any purchaser or investor is going to be interested in knowing what's the scope of this exposure and what is the potential timing and chances of resolving them. So yeah, just to state almost the obvious, right? Costly and uninsured litigation is going to be a concern for any investor or purchaser, but you can take proactive steps to try and mitigate that risk, or at least have a really good understanding of what that risk entails, and have a plan to get that thing resolved. So with that, I'm going to turn it back over to Jason to talk a little bit about restrictive covenants and incentive agreements.
So if you're going to be involved in a transaction process, it's important to consider whether any executives or other key persons are going to be active in that process. And if so, whether you're going to want to put into place any customized arrangement in advance of that process, whether that be with respect to change of control provisions or retention terms to ensure that these persons stay on after a sale or the transaction is completed. With respect to restrictive covenants, it's going to be important as part of the process to determine which employees are covered by them, whether they're non-competes or non-solicitation provisions, which tend to be the most important ones that we look at in the transaction process. And as you may be aware, restrictive covenants, at least at this time, are subject to regulation on a state-by-state basis. And so you really need to look at the local laws, the state and local laws, what the requirements are, as Ellen mentioned earlier when talking about compliance. But these are particularly important, though, with key executive personnel, because someone who's investing or acquiring a business is going to have concerns over whether these key personnel are going to leave in connection with the transaction. Could they possibly compete with the business? And could they raid the business's talent? Also, you want to ensure that any non-equity or non-equity incentive agreements are current, documented, and accurate, because investors and acquirers will want to review the terms of these agreements during the diligence process. And any failure to properly document these arrangements can have a material impact on a potential transaction, the employees at issue, and the business. So in addition to working with L&E folks like Ellen, Ryan, and me, it's going to be important also to work with benefits and tax counsel to ensure that these arrangements are properly finalized. With that, I will turn it over to Tony to talk about supply chain issues.
Thanks, Jason, and good afternoon, everyone. So, sophisticated investors and acquirers are going to want to ensure that there's going to be continuity of supply and stability in the supply chain. It's very hard for a restaurant or for any business, for that matter, to maintain profitability if you do not have products to offer to your customers. So, in preparation for a transaction, and particularly in light of current events and the state that we're in now with tariffs and Liberation Day, you're going to want to understand your supply chain and where your products are coming, and that's not just your finished products, but also any key components or materials within those, and how that is going to be impacted by the new climate with these tariffs. So first things first, you're going to want to understand, what contracts you have out there. And there's a difference between, pricing term sheets and pricing for your products and supplies versus a contract that's going to give you, more protection. And so in preparation for a transaction and just in general, good business practices, you're going to want to ensure that you have contracts in place, particularly with your key suppliers. And then you're going to look at, from a diligence standpoint, considerations that you're going to factor into with any material contract. And so, the impact of change in control and assignment provisions, if there are any exclusivity requirements with a supplier that would prohibit the acquirer to, use a supplier that they may already have in their system. And so exclusivity is also going to impact your ability to maintain supply if there's an issue with that particular supplier. So you want to really understand your supply chain and the various components of your supply chain to be able to explain to an investor or a potential supplier, where you're sourcing your products from, what impact, if any, will the potential tariffs have. What contractual protections do you have in place to, try to counteract that or to mitigate the impact of those, and ensuring that, you will be able to maintain the stability of that supply chain when ownership changes hands or there is a change in the transition as a result of the transaction. Also, if you've had any performance issues or disputes with a particular supplier, it's good to get in front of that and make sure that you are able to address it and understand what the contract provides you in the way of remedies, which is another key point in understanding that a contract will provide you remedies that a pricing sheet won't. And so making sure that you have proper protections in place will help to make sure that your house is in order for the potential investor or acquirer. And with that, I will turn it over to Joe to speak on tax.
Thanks so much, Tony. From a tax perspective, buyers and investors really focus on a couple key factors when engaging in a transaction. The first is structuring the transaction in a tax-efficient manner. This includes both the transaction steps themselves, but also the go-forward tax structure. For example, will the buyer get a step up in the assets of the business to be able to amortize or depreciate its investment? And similarly, sellers need to focus on the tax structure as well, because that'll impact the tax treatment of their transaction proceeds and any potential rollover equity, making sure that is tax deferred. The other major area of focus from a tax perspective is confirming that there aren't any historic tax liabilities or any looming tax issues or potential audits. As is natural, buyers always prefer to acquire or invest in a business that doesn't have any real tax risks or issues. And when there are tax risks or issues, whether or not the buyer will accept them really depends on the nature of the transaction, the leverage of the parties, and the circumstances. But the key component there is just by having the knowledge and whether or not there are these issues. Often sellers and operators won't even know that these issues are sort of there and pending before a transaction. But with that knowledge, there might be steps, and are often steps we can take to address them to make the transaction go much smoother. And so, well, how do you get ready to address these in your sale process? The first real step is to prepare an organization chart with each legal entity and its tax classification. These days, we see a lot of LLCs, and an LLC can be a partnership for tax purposes. It can be an S corporation or it can be a C corporation. So really drilling down on how each entity in your structure is treated is crucial. And that will give both your transaction team and the buyer the ability to come up with a structure that's mutually tax efficient. The other key ingredient of being ready from a tax perspective is to communicate early and often with your accounting and tax team regarding the transaction, making sure your accountants and tax return preparers are up to speed and know that the transaction is coming. That might change how they'll report certain things on your tax returns in the year coming up to the transaction, whether or not you should be making estimated tax payments, things like that. And in connection with diligence, all of those items are going to need to be provided, tax returns and not just income tax returns. There's the whole slew of tax items that are going to need to be provided to the buyer. So having your accounting team, tax and accounting teams ready to provide that stuff will make your process much smoother. And it'll also help as you go through your purchase agreement or your investment agreement, because those documents inevitably will have pretty extensive tax related reps and warranties. And it's important to make sure that you can make all those reps and warranties and that you're not leaving yourself open to potential future liability. And then some of it is just basic blocking and tackling, making sure that all pre-closing tax returns are filed and filed timely, and making sure that you've complied fully with all tax reporting requirements. Often investors will take a more will want to take a more conservative approach when it comes to taxes than an independent operator. So making sure that your accounting and tax advisors understand that will make sure that you're best prepared. And with that, I'll turn it over to Brett to address some concerns and considerations related to franchisors.
Thanks, Joe. One of the primary assets in any restaurant franchise are the franchise agreements and the franchisees operating under those agreements, right? Because that's where the royalty stream is derived, and that's obviously of great value to any acquirer. And so that one of the key focuses of any sophisticated party is making sure that the royalty stream is sticky, meaning that it's not going to dissipate after you make the investment. And so you can kind of foresee the areas that sophisticated buyers are going to be looking at. And so we always work with our restaurant clients that are preparing to transact to do sort of a mini diligence process in advance to make sure we understand the health of the system, and so that we can proactively address or try to mitigate any concerns that might pop up during diligence. Here are a few of the items that obviously are going to be of big focus. The first is obviously the franchise agreement. That's the agreement that the franchisees are operating under, and it requires that they pay a royalty. And so doing a preliminary look at these franchise agreements to make sure that they're enforceable, to make sure they're signed, to make sure they're all still in effect and nobody's operating post-expiration, are all things that we ensure just to make sure that we really understand the strength of the franchise agreements and the revenues that are paid thereunder. It's also very important to make sure that we compile any addenda that may have been signed in conjunction with the franchise agreements, because while all the franchise agreements may require a flat 6%, 7% royalty, it's not unique to have side letters and addendum that modify those payment metrics. And so, of course, having an understanding of where those are and where they exist is very important as diligence starts to ramp up. The next is regulatory compliance, obviously. Federal and state law require franchisors to prepare and disclose a franchise disclosure document before engaging in franchise sales. And so it's important to make sure that the restaurant franchisor has been preparing a disclosure document, that there aren't any material omissions, that they've been filed properly in the states that require filing, and maybe even more importantly, to make sure that they were registered in the states at the time in which they engaged in franchise sales in those states. This is obviously important because you might have 250 franchisees, but to the extent that they're all in a state that required registration and registration was lapsed at the time of sale, all those franchise agreements could be rescinded, or the franchisees might have the ability to rescind those agreements, thereby greatly reducing the royalty stream and potential marks against valuation. Next, obviously, in addition to making sure that the agreements are strong and making sure the regulatory scheme has been followed carefully, is looking at the franchise relationships in any brewing or extant litigation. To the extent franchisees are unhappy or there's potential strife, it's often recommended to try to resolve these issues pre-transaction to the extent possible, so that there aren't, numerous default letters outstanding or pending litigation at the time of the transaction. So always recommend, if there are franchisees that you think need to be out of the system, trying to address that proactively before the diligence process is underway, to try to mitigate or reduce concerns about the franchise system diminishing post-transaction. Next, back to Kelsey.
Thanks, Brett. I think the last considerations we're going through is just a couple here. The first is licenses and permits. This is an area where the seller is going to want to know that you're operating with required licenses and permits, that you're not at risk of losing any. This is an easy one to get on scheduling out ahead of time, confirming that you have all that you need and that all are in good standing and are current with the applicable authority. There's special considerations you're going to want to pay attention to when it comes to alcohol, liquor licenses. In this area, there's a lot of state-specific rules and some just rules that you might not know about. And given the jurisdiction-specific rules, often local liquor council will get involved. You'll want to get your arms around any pre or post-closing conditions that may exist in each state where your company is doing business. Material contracts, as a part of every transaction, a seller usually will need to disclose all material contracts. So this is another good one to schedule out ahead of time and confirm that you have fully executed contracts on hand, or track down any ones where you don't have the fully executed. Material contracts are usually contracts that are over a certain threshold amount that usually can't easily be canceled without a penalty. They have special provisions in them, non-competes, most favored nations, things like that. So you'll want to take a look at those and see if there's any contracts that could be problematic to a transaction, because in advance you could, amend, terminate, see any changes that you need in your material contracts. Lastly, data privacy and security. As a part of a transaction, a seller would typically need to represent that it's compliant with information privacy and securities laws. This is an area that's been taking on greater significance the past several years as data privacy requirements have evolved. Also, data breaches have become a bigger issue with, potentially pretty negative financial consequences. And so, a buyer is going to want to know if there's any exposure there. So as part of your pre-transaction prep, you'll want to have privacy counsel involved to review your written information security policies, your marketing practices, your mobile app compliance, your privacy policy, take a look at your website, and also just make sure you have any kind of data protection agreements that you need in place, and that you're in compliance in this area. With that, I think we're ready for Q&A.
Yeah, thank you, Kelsey. If anybody has any questions, we still have a couple minutes remaining. If you'd like to submit them through the Q&A feature. I'm not sure if we can unmute anyone, but if we can, we could do that too.
Yes,
Any
they should be
questions?
able to unmute and ask their questions if they'd like.
Oh, terrific. Yeah, if anybody has any questions, fire away. We got a couple minutes left.
Hey, Riley. You mentioned earlier that an S Corp might be an issue versus, I guess, an LLC would be the other option. Do you have like a brief answer as to why the S Corps could present a problem?
Yeah, good question, John. And we go into some detail on this in the article. S Corps has some limitations that come up in these types of transactions, especially if it's a professional investor or a private equity group or an entity investor. S Corps cannot have entity investors, or almost nearly any type of entity will disqualify an S election. So if you're an S Corp and you take an investor that's an LLC, S Corps can also not have different classes of equity. So in many transactions, especially a growth restaurant financing with a private equity group or professional investor, they're going to want what's called preferred equity of some type, that sits above the common equity in some form, and that cannot exist in a S corp. There's also limitations on the number of investors and other items, but there are ways to restructure in advance, and we do that a lot in these transactions. So it's very common, but it's very important. And I know Joe, our tax lead, might want to elaborate on this, but the consequences of blowing an S election, going through the stop sign can be significant.
Got it. Thank you. So LLC would be preferred, or are we talking C corp at some point?
LLCs are more of the rule than the exception with many restaurants these days. That did not used to be the case. 15 years ago, C corps were the rule and LLCs were the exception. LLCs have become more common. C corps are not uncommon. We still have many restaurant clients that are structured as C corps, but they're very different in terms of tax treatment and so forth. So if folks are starting companies or just have not yet made the decisions, it's important to speak with your accounting and legal tax team to understand the best options given your objectives.
Great, thank you.
Welcome. Any other questions?
Looks like we got a question in the questions box. Any insights on the recent transaction revenue and EBITDA multiples? Or I might have said that wrong.
Yeah, that's always a great question. There was a rule of thumb back in the day, and it still kind of is, that at least for company-owned restaurant groups, you're looking at between a 6 to 10x store level cash flow multiples for growth restaurant brands, a little bit lower for what you call mature brands. Often it's hard to say what is a growth or mature brand. It's usually how long it's been around, a number of locations and so forth. I think transactions, for concepts with multiple locations under a single brand still often fall within that valuation range, but there's room on both sides of those edges. There's been some transactions that have really taken those metrics and gone in different directions on both ways. And it's all situationally dependent on a variety of factors. Is what is the growth and scalability of the brand? Where is the capital being used? Is it what we call primary balance sheet capital towards growth, or is it secondary, meaning money that's coming out to the investors? Is it a preferred security structure? If it is preferred, what are the preferences? Is there a PIK or a coupon or other things on top? So it could get very detailed, and there's a lot of important things to understand in terms of valuation and multiples. But things are still generally falling within that type of range. I mentioned on most deals that at least we have seen. Any other questions?
Yeah, we had one more. They said, what are privileged audits in labor and employment?
Ellen, you want to take this one?
Sure. So a privileged audit is an audit that is conducted by legal counsel for the purpose of providing legal advice. The benefits of conducting an audit in a privileged manner are to, of course, create confidentiality and privilege surrounding the information that is collected during the audit. There are, of course, some limitations to what is ultimately going to be deemed privileged if there's ever a question as to kind of what happened during that audit and what it uncovered. Certainly like underlying payroll records, wage statements, the types of documents that are reviewed are never going to be privileged, nor can they become privileged by virtue of an audit. But the information that is acquired during the audit and the recommendations that may come out of the audit and the outcomes of the audit would remain privileged. And so that's the benefit of doing so in a privileged context, as opposed to the audit, let's say, just being conducted by HR or other, a HR consultancy, an external HR consultancy. They would never be able to create any privilege or confidentiality around what was discussed.
Well, thank you, Ellen, and thanks everybody for your time. Great questions, great participation. We'll be circulating the slides and as well as the again. So if anybody has any questions about transaction preparedness or needs help, obviously, we'd love to speak with you. And thanks again for everybody taking the time today. Our next webinar is next week. It's on airport restaurant transactions. If anybody would like to join, it's a fun and exciting space for restaurateurs. So hope you can join that too. And we welcome your suggestions for future webinar topics. We would love to hear from you about those. So thanks, everybody. We hope you have a great rest of the day. We'll see you soon.